For us, obviously, there's two things to kind of think about. We have our existing portfolio, but also we think about new opportunities as well. And so in our existing portfolio, we feel very good kind of where we sit today, mainly because we really built a portfolio that has a lot of flexibility and defense mechanisms within it, in the sense of our companies are significantly hedged in the near term, have very little leverage, are concentrated in the highest quality plays, and also have kind of lease terms, either that are held by production, meaning we just don't have a gun to our head we have to drill anytime soon, or also extended way out. So we are focused on that, and more specific on that, in light of the big drop in oil prices, we are reducing CapEx budgets, shifting a lot of the drilling programs kind of later in the year into 2016, and spending time a lot of our companies there. But the good news for us is we just don't have a lot of companies in the emergency room. As far as new opportunities, certainly the price pullback really is creating opportunities that have been unfathomable 3 or 4 months ago. Now, just because prices fall and things look cheap doesn't necessarily mean they're quality. So I think over the next 6, 9, 12 months, the quality is going to rise to the top as some of the hedges kind of roll off, which is really going to create we think a very exciting buying opportunity for companies with dry powder. So balancing both of those, but fortunately for us, we're in good position, I think, to take advantage of both. When you look at prior to the crisis, you think about, we had identified roughly $8 to $10 trillion worth of opportunities in North America across upstream and midstream, and the industry was spending roughly $350 billion a year. And so there's a big disconnect between what was actually being spent and what the opportunity was. So really, at the end of the day, the industry was actually suffering from a lack of capital overall. Now, there's been a lot of private equity raised that we kind of estimated somewhere in the $85 to $100 billion raise, which has been raised over the last couple of years. Currently being raised, will be raised over the next couple of years, and certainly that's a factor. But in the bigger scheme of things, certainly the industry can withstand that. Now, to play devil's advocate, certainly with this more private equity coming in, certainly you are having more competition. You're going to have companies that really don't deserve capital, that are going to overpay for stuff, and that's going to create some headwinds that we have to face. But I think all in all, I think we feel like, sure, there's been more capital come in, but the industry can certainly support it. And we're going to have to work harder, but we think it's still going to present great opportunities where we can generate 25–30% rates of return. Near term, we think that prices are going to stay very low. Just the supply-demand fundamentals that we're facing, not only in the U.S. but globally, just doesn't lend itself that you can make a really rational argument that prices are going to increase anytime soon, other than something happening in the Middle East, whether it's a war, battle breakout. Obviously prices can change on a dime. So we're prepared as a firm that we expect prices to continue to persist low, certainly for the balance of the year. But the good news is service costs are going to come down. So plays that the break-evens are going to go way down. So we're in a number of plays that are going to be highly economic, even at lower prices. So we expect us to pick up more activity at our portfolio company level more in the second half of the year and early 2016. But as far as near term, we expect prices to stay low. And projecting it out, as some of the hedges start rolling off some of these companies, I think it's actually going to create more buying opportunities a year from now, and more actually stress in the market. I think for now, people are relatively hedged currently, and a lot of the debt that they have is more termed out. So again, people are thinking there's going to be a lot of stress in the market today. I think that's going to play out more over time as these lower prices persist. But we expect that to continue. I think in a year from now, you probably will see some supply-demand response as the growth rate of production in this country slows down. And because of you think about gasoline demand and all these things, it's actually a boon to the consumer, not only in the United States but worldwide. There's more money coming into their pocket because of lower gas price. I think you will probably see some incremental demand, but it's really hard to predict, and we just don't see it happening anytime soon.